What if the biggest financial mistake of your life did not feel like a mistake? No bankruptcy, no scam, no terrible business deal, no moment where everything falls apart at once. Just one quiet sentence. I'll start investing later. And the scary part is, nothing happens when you say it. Your life keeps moving. You still go to work. You still pay bills. You still buy food. You still scroll at night. You still tell yourself you are being responsible because you are not doing anything reckless. But somewhere in the background, something invisible starts counting. Time. And time is strange because when you have a lot of it, it does not feel valuable. It feels normal. It feels like air. It feels like something you can always use later. That is how the mistake hides. It does not arrive dressed like danger. It arrives dressed like a normal month. I'll start next month. I'll start when I make more. I'll start when I understand the market. I'll start when life calms down. And because nothing bad happens immediately, the sentence feels harmless. Now imagine a very ordinary version of your life. You are not rich. You are not a finance genius. You are not watching charts all day. You do not know which company will win. You do not know what the market will do tomorrow. You just decide to invest $300 a month into a simple broad stock market index fund. Not one random stock. Not day trading. Not trying to guess the next big company. Not chasing a stranger on the internet who acts certain about the future. Just a low-cost index fund that follows the market broadly. And for this story, let's use an 8% average annual return over the long run. That does not mean every year is good. Some years are terrible. Some years are amazing. Some years feel like the account is barely moving. Some years make people panic. But over decades, the math starts doing something most people do not feel at first. After the first month, you put in $300. It looks tiny, almost embarrassing, and honestly, in the beginning, it does not feel powerful yet. After 1 year, you have put in $3,600. That is real money, but it probably does not feel like freedom. It feels like a small account on a screen. After 5 years, you have put in $18,000. The account might be around $22,000. That is better. But still, it probably doesn't feel life-changing yet. So this is the first test. The beginning asks you to keep doing a boring thing before the reward feels big enough to impress you. And that is where many people stop. Not because they are lazy, because the progress is too quiet. You are putting real money in, but the account is not shouting back. It is just sitting there, slowly building. After 10 years, you have put in $36,000. Now, the account could be around $55,000. This is when something changes. For the first time, the account is not just what you deposited. There is money in there that did not come directly from your paycheck. The gap is not massive yet, but you can see it. Your money has started working with time, and once that happens, the story changes. Because in the early years, your deposits do most of the work. But later, your old money starts working beside your new money. Then the gains start creating more gains. And those gains begin creating more gains after that. That is compounding. It is not magic. It is not a secret trick. It is not a shortcut. It is just money, return, and time, repeating long enough that the result stops looking normal. After 20 years, you have put in $72,000, but the account could be around $178,000. Stop there for a second. You contributed $72,000, but the account is more than double that. More than half of it did not come from your pocket. It came from staying in the game. It came from time. It came from not quitting during the boring years or panicking during the scary years. Then, after 30 years, you have put in $108,000. The account could be around $447,000. Now the difference is not small anymore. At this point, your account can move in a way your monthly deposit never could. A good year can add more than you personally contributed that year. A bad year can feel painful because the account is finally large enough for the swings to matter. Then after 40 years, you have put in $144,000, but the account could be around $1,047,000. Over $1 million. From $300 a month. And this is the part most people understand too late. The early deposits do not look impressive, but they are the deposits that get the longest time to work. The first $300 is not powerful because it is large. It is powerful because it gets decades to multiply. And this is where waiting becomes painful. If you wait before starting, you do not just lose the money you would have deposited. You lose the time those deposits would have had to grow. That sounds simple, but the numbers make it uncomfortable. Someone starts now with $300 a month. Someone else delays, then starts with the same $300 a month. Both invest in a broad index fund. Both use the same average return assumption. Both are normal people. One person simply gave their money more time. After the full journey, the early investor could have around $1.47 million. The delayed investor could have around $447,000. The difference is about $600,000. Not because one person was smarter. Not because one person found the perfect stock. Not because one person predicted the future. Because one person started earlier. That is the quiet truth. Most people think wealth is built by finding the perfect investment. But for normal people, wealth is often built by doing a boring thing for a very long time. A broad index fund. Automatic monthly investing. Low costs. Consistency. Not panic selling every time the market falls. Not stopping because the progress looks slow. Not needing the account to entertain you. But the beginning is supposed to feel boring. After 1 month, nothing changes. After 6 months, life looks the same. After 1 year, you may even feel disappointed. But the math is not sleeping. It is just slow at first. Then one day, the number starts moving in a way your paycheck never did. And when that happens, you realize something important. You were not just saving money. You were buying time. Time for your future self. Time away from panic. Time away from needing every paycheck to survive. Time away from saying yes to everything because you have no cushion. That is what money can buy when it is used well. Options. The option to breathe before making a decision. The option to stop treating every emergency like the end of the world. But the market will test you before it gives you that feeling. It always does. There will be red days, bad headlines, crashes, fear, people saying this time is different, and sometimes it will get worse before it gets better. A broad index fund is not a promise that every year will be good. It is not a guarantee that the next month will feel safe. It is not a shield from volatility. It is a long-term bet that over many years, businesses keep producing, people keep working, companies keep earning, and the economy keeps moving forward. That is why the real challenge is not just investing. It is staying invested. Because the big number does not come from one perfect day. It comes from surviving all the normal days, the boring days, the scary days, the days where you almost stop because nothing seems to be happening. This is where automatic investing matters, not because it is exciting, but because it removes the need for you to be emotionally perfect. The system runs, the deposit happens, the money goes in. That does not mean you should ignore real life. You still need cash for emergencies, and you still need to understand risk. But once the basics are handled, the habit matters. Money you almost invested does not compound. Money you plan to invest later does not grow. Money you meant to move someday stays exactly where it is. The market cannot work on money that never enters the game. And that is why the first deposit matters so much. Not because $300 changes everything instantly. It does not. The first deposit matters because it proves the habit exists. It turns someday into now. And once the habit exists, it can repeat. 1 month becomes 2. 2 becomes 12. 12 becomes years. Then the balance becomes options. And options become peace. Maybe that is the real lesson. You do not invest early because you already have a lot of money. You invest early because time is the one advantage you can never get back. You can earn more later. You can learn more later. You can increase the amount later. But the years you wait are gone. The first deposit looks small. The first year feels boring. The first few $1,000s may not impress anyone. But the last decade can be massive. And one day, the money you almost spent without thinking could become the number that changes everything. Not all at once, not loudly, not in a way that looks dramatic from the outside. Quietly, month after month, through normal days, through scary days, through the years when nothing seemed to be happening, until one day you look back and realize the small decision was never small. It was the first door.